and welcome back. Again, my name is Lester Kivet, and I'm joined here by Sanesh Albert, who is my co-host here this afternoon, and welcome back from this break. And if you had not yet watched the pre-recording oral presentation, be sure to do so. They are available on the app. So let's get straight into our final breakaway session of the day. It's our first of two presentations here in this particular stream. Our first, climate risk testing in banking and general insurance.
Thanks, Lester. So this presentation will give us insights into how to conduct climate risk stress testing, climate risk measurement in banking and general insurance, the banking and insurance interplay, the need for a macroeconomic impact, and considerations in physical transition risk and portfolio management.
Sanesh, we all know climate risk is a hot topic, and I've been waiting all day to say pun not intended. And I welcome onto our stage our two presenters, Jerome Mahadeo and Christopher STERLEY. Good day, Christopher. Good day, Jerome.
Thank you. Good afternoon and a warm welcome to our session on climate risk stress testing, focusing on banking and general insurance. Over the next few minutes, we hope to shower you with some of our insights gained on the topic, working with it over the last few years. In the last 12 to 18 months, we've heard of numerous headlines around the topic of climate risk. For example, European countries record the hottest September temperatures ever. Closer to home, climate change in Africa, 160 billion rand lost, and over 100 million lives directly affected in 2022. Further, the South African Prudential Authority has deemed climate risk a flavor of the year. And as such, climate risk stress testing is an important tool for organizations to assist them assess the impact of climate change. Up until recently, there has been little to no guidance on how to actually perform a climate risk stress test, which components to model, how to put it together, and who to hire to get this done. The presentation will cover the definitions of climate risk, a framework for conducting a climate risk stress test, the importance of the banking and insurance interaction for this risk type. It'll also cover some guidance and papers from international bodies, as well as skills required to put this together and where actuaries could fit in. A good place to start would be around definitions. The first to clear up would be the difference between weather and climate. Weather is the short-term state of the atmosphere, usually referenced up to days or weeks, whereas climate is the long-term pattern of weather, referenced up to decades. Moving on to the definitions of climate risk. This is usually broken up into two sub-risk types, physical and transition risk. Under physical risk, acute physical risk is the costs or losses associated with an increase in frequency or severity of weather-related events, such as storms or wildfires. Whereas chronic physical risk is the risk associated with the long-term change or the long-term gradual change in the climate, such as rising sea levels. Transition risk, on the other hand, are the risks associated with the movement toward a lower carbon economy. This could take various shapes or forms. For example, any changes in regulations or legislations around emissions, an introduction or modification to carbon taxes, or the risks from moving away from carbon-sensitive products and services to more efficient carbon products, services, and technology. We will take you through some of these risks in detail through the presentation.
Great. So with those definitions in mind, let's look at an example of how climate risk can impact a financial institution. Let's assume that we have a counterparty based in the Durban region who is in charge of storing cars as they're moved from the Durban port and before they're transported to the rest of the country. For this counterparty, we have a range of loan facilities, and we offer general insurance cover for the cars as they're stored. Now, given that they are in the Durban region, flood risk is a material consideration, meaning that if there is an increase in the frequency and severity of floods, there could be more claims, and any damages to their facilities that isn't otherwise covered by general insurance may result in reduced cash flow and ultimately a reduced ability to repay their loans. On the transition risk side of things, a carbon tax on the automotive industry may result in our counterparty needing to pay additional tax, reducing their cash flow and ultimately increasing their probability of default. But even if they aren't producing the cars themselves, a tax in the automotive industry may result in reduced demand for their services as a result of reduced supply of cars because of this tax, which would reduce their revenue, reduce their cash flow, and ultimately reduce their ability to repay loans. So what this example shows is that it's convenient to think about climate risk as being a risk enhancer. In other words, it takes risks that we already know and already understand and makes them better or worse. From the example, we saw that climate risk can increase defaults, so there's a credit risk implication for banks. It can increase the number of claims compared to our historical experience, so there's an underwriting risk for general insurers. And for both banks and general insurers, there could be an operational risk consideration through any damage to operations or in any way in which employees are impacted. And from a market risk perspective, something like a carbon tax, even just using a simple discounted cash flow approach, could have a significant impact on equity prices for several sectors, leading to severe and widespread financial market ramifications. This type of thinking also provides a common point of communication. So instead of thinking about climate risk as this murky thing, we can rather translate it through our internal communication around things like credit, underwriting, and general claims considerations. So we can bring risk professionals into the conversation who have 10, 20, 30 years of experience, but who may not otherwise understand climate risk to a full extent yet. They can still add to the conversation and help us better understand this risk type so that we can perform the best as possible as an institution. It also provides a useful framework for assessing climate risk in the first place. So rather than thinking about it as being the standalone risk type, we can rather think about it in terms of increasing defaults, increasing claims, and potentially even resulting in more operational losses. So the first question we should really be asking is climate risk material? So this graph gives a dummy example of a potential flood event, say for example, that might affect our counterparty in the Durban region. On one axis, we have the default rate, which is an indicator of risk for banks. On the other axis, we have total claims, which is an indicator of risk for general insurers. So what we see is into the lead up to this flood event, things are going as normal. Our claims are as expected, our defaults are as expected, but then during this flood event, the number of claims increases significantly as a result of general insurers having to process all of these flood-related claims before things ultimately go back to normal. On the banking side of things, the default rates during this flood event might increase slightly before some recovery, and then things eventually go back to normal. Now, what this could illustrate is that some of the flood-related defaults could actually be individuals who otherwise might have defaulted in the future, just defaulting slightly earlier, kind of making this a bit more murky. But the other thing to potentially take away is that if you are looking at this as a risk manager in a bank, you might say that your portfolio is largely insensitive in the face of physical risk. It's important, though, to look at these numbers in the context of what's happening. The fact that general insurers are experiencing such high losses means that the financial impact of a flood can be severe. If insurers act on this information and pull their cover from a high flood risk area, these graphs could actually invert, wherein banks could see significant losses during a flood event as a result of their counterparties not having a risk transferring mechanism for those flood risks, ultimately transferring that flood risk to the bank itself. General insurers then could see a minor blip in their total claims as a result of not having exposure to this region. So what this example shows is that it's important to account for the context behind any numbers when looking at climate risk and ensuring that you're accounting for any mitigations that might be affecting your sensitivity to physical and transition risk. So how do we actually go about measuring the extent of the materiality of climate risk? This is where stress testing comes in handy. But why would you perform a stress testing exercise? Why would you rather just predict the future climate? The first reason is that reserve banks and prudential authorities around the world have elected to use climate risk stress testing as a means of managing climate risk stress. So if it's a regulatory exercise, you may as well build on it and improve it for your own internal systems. And there's also potential for then integrating this information to things like ICAPs and ORSAs. The second reason is that it is incredibly difficult to forecast the climate. Firstly, weather forecasts are generally only viable for about 7 to 15 days into the future, which is not exactly useful when you need a 30-year forecast. Climate is also difficult to forecast because you need to be able to forecast emissions, which is based off the actions of countries and counterparties around the world with agendas that might be changing over time as well. It's easier to rather set a scenario, a representative carbon pathway, which gives an illustration of potential emissions leading up to a certain level of global warming, and then understand how that results in a certain level of climate change, so that we can then focus on how the climate is actually impacting our financial position, rather than trying to spend too much time trying to forecast the climate in our own right. The added benefit of this is that it's easier to adjust the scenario than it is trying to maybe forecast additional variables or change our view of a particular forecast for something else we're trying to test. So, how do you perform a climate risk stress testing exercise? Thankfully, the step-by-step process is broadly the same as a macroeconomic stress testing exercise, which we've been performing for years within financial institutions. The first step is to relate your key variable to your risk. So in the context of a climate risk stress test, that's relate your climate variables to your risk. For a macroeconomic stress test, relate your macroeconomic variables to your risk. Step 2 is then forecast your key variables. And step 3, measure the results, and specifically for a climate risk stress testing exercise, analyze those results. The reason why I've included that additional step is because, and we'll see this in this presentation, the types of data we'll get out of a climate risk stress testing exercise is likely to be different from what we've seen before as a financial institution. So we need to make sure that we spend enough time and resources to adequately understand the results so we can maximize the strategic value that we get from those numbers. So we can start on step 2 of a climate risk stress testing exercise, and the reason being that it actually provides an easy win. The Network for Greening the Financial System is an international organization made up of reserve banks and prudential authorities around the world. The South African Reserve Bank is actually a member of this organization, which gives it something of a rubber stamp of approval. What they do is, or their intention, is to standardize how climate risk stress testing is performed around the world. And in order to do so, they provide things like advice on how to do the stress testing, climate scenarios, climate forecasts, transition risk forecast, and even macroeconomic variable forecasts as well. What this means is that they've done the heavy lifting in terms of forecasting these climate variables so that we can just focus on the actual relating climate to our financial position, which we can understand better than an international organization, so we can actually complete the full climate risk stress testing exercise. Now, onto the hard part of the presentation. How do you actually relate climate to your risk? Thankfully, another international body has provided a framework that we can use for assessing climate or catastrophe risk. The International Panel on Climate Change is associated with the UN and is generally seen as an authority on climate change around the world. So the framework that they've proposed for catastrophe risk has undergone a degree of scrutiny and can generally be seen as fit for purpose. So they've defined catastrophe or climate risk as being a combination of a hazard, an exposure, and a vulnerability. So looking at this through a physics risk lens, we can think of a hazard as being some weather event that results in an economic loss, things like a flood or a fire. Now, I'll note at this point that climate scientists may define some of these terms slightly differently to a financial institution. It's important to ensure a consistency in definition, both within other risk areas as well as within climate risk, and to ensure that the philosophical considerations presented by each term is accounted for in some shape or form. So we would define exposure here as, are we, or is one of our counterparties potentially exposed to a hazard? For example, are you in a high flood risk area? Or are you potentially at the top of a hill? So even if a flood occurs in your area, you maybe aren't impacted. Lastly, vulnerability speaks to any actions taken by our counterparties in order to reduce the economic effect of climate risk. So in a banking context, that might be something like insurance cover, and for both banks and insurers, that would speak to adaptation, where adaptation in this context is building something like a flood wall along a river in order to reduce the impact of the river overflowing, or building fire or flood-resistant housing. So we can zoom in a bit on the hazard component of the model, and this list of hazards gives an indication of the potential hazards of concern for South Africa. It's not an exhaustive list, but it is a useful place to start from. But it's important to note at this point that not all portfolios are due to be impacted by all hazards in the same way. For example, a household who might have household insurance or a home loan might be more concerned with flood and fire than they might be concerned with the other hazards on this list. What this means is that we can actually focus more on those hazards, understand them better, and don't necessarily spread our resources too thin by trying to understand too many hazards at one time. Thereafter, we can look into the exposure component of the framework. These two graphs are rainfall forecasts for South Africa provided by the NGFS under a severe climate scenario. The first graph is at a net South African level, and the second graph is at a more granular South African level, specifically at a 50 kilometer by 50 kilometer region. This information is all freely available from the NGFS and can be accessed right now. Now, what the first graph shows, if we just look at the range, is that the adjustment in rainfall could go from somewhere between minus 0.4% to minus 1.6%. On the second graph, the range in change in rainfall goes from around positive 5% to negative 15%. What this means is that if we don't account for the geographic granularity within our physical risk model, we're likely to significantly overstate the risk for some areas and significantly understate the risk for others. Geographic granularity is a key consideration in order to account for the fact that climate varies significantly throughout the country, but climate change is also likely to vary as well. The last component is vulnerability. So as I mentioned, this is where we look at things like insurance cover and adaptation, but it's important to account for vulnerability both historically, in terms of calibrating our models, as well as in future, in terms of assessing the actual losses we could face. Now, the historical calibration, we can actually go back to our original example, where we had that flood example, general insurance claims rising, bank defaults not necessarily rising as high. If in that example, we say that there is, say, a 90% insurance cover, that means that only 10% of our portfolio is potentially exposed to flood risk. So that movement in our credit parameters could actually be driven by 10% of our portfolio being impacted, meaning that that 10% is actually highly sensitive to physical risk. Whereas if we don't account for vulnerability, we're implicitly assuming that our entire portfolio could actually be impacted by climate change in the first place. Thereafter, we need to account for vulnerability on a forward-looking basis. In other words, insurance cover, adaptation, those things might change into the future. And we're already seeing examples of this play out today. There are cases, for example, in California, where insurers have reduced their exposure to the area because of high wildfire and drought risk. And even in the UK, the Bank of England noted in their climate risk stress testing report that insurers might resort to reducing their exposure or even removing certain areas from their book, especially if that area was a high flood risk, in order to mitigate their risk. So if our portfolios become more vulnerable over time, even if hazards aren't becoming more frequent and more severe, our losses could still increase as a result of our portfolios or more of our portfolio being affected by climate change. So let's look at this framework as being applied to a credit example. Again, going back to our original example, flood risk in the Durban region. Because we are looking at flood risk, we would specifically look at the change in flood risk. And it's important at this point to note that the change in flood risk is a key consideration. The reason being that floods have occurred prior to climate change and will likely occur even if we're able to solve climate change in future. What that means is that any default data that we have implicitly accounts for flood in the first place. So if we account for the full flood risk, we'd be double counting risk relative to our historical basis. So we would need to assess this change in flood risk. This may require some internal modeling or potentially an externally sourced model, which is a viable approach given that banks don't usually look at flood risk. Then we would need a credit model that's capable of consuming flood risk, or certainly the change in it, and giving some form of credit adjustment. Now, instead of looking at a specific model, it's important to note that any model that is used needs to be consistent with your internal credit risk measurement models, especially the ones that apply to economic capital. If it's not, you could have a situation where your climate risk model is pulling you in one direction and your economic capital model is pulling you in another. The added benefit of this is that, and we'll see this by the end of the exercise, we're going to have made many assumptions in order to get to a climate risk adjustment. Any opportunity to reduce the number of assumptions that we've made to actually get to this impact adjustment is an absolute win. So we take this change in flood risk, we feed it through an internally adequate model, and then we get a probability of default and a loss given default as an output. It's important to look at both PDs and LGDs. The reason being that physical risk is likely to impact PDs and LGDs in the same direction. If there's a flood, you're more likely to see a default and also a loss in the case of default due to increased damages. What this means is that there could be a PD-LGD correlation implication as a result of physical risk. So if you think about things in terms of a credit loss distribution, the tails of your distribution could be pushed further out, meaning that your economic capital impact could actually be exacerbated by physical risk. Applying the same example to general insurance. So as general insurers might have more of a focus on flood risk in their day-to-day activities, they might want to look at the change in drivers of flood risk. In this context, there would be something like changes in rainfall patterns, land use types, and elevation. But most of those variables are incredibly difficult to forecast, if you can even find one. But we've already seen that rainfall forecasts are available. So we can then feed this rainfall forecast into any internal models that might be available, or potentially externally sourced models. But I will also note that if you do source a flood assessment model, it's important to validate that model, firstly to understand any assumptions being made, and secondly to understand whether it's actually fit for purpose. There have been cases of individuals trying to sell flood risk models, which otherwise aren't actually good indicators of the actual potential damage associated with the flood. This is also a potential case where the presentation presented by Ron and Kovlin on the climate data impact on claims could actually come in. Your flood risk assessment model could even just be a regression of flood claims versus, for example, rainfall. But ultimately, you'll get to some form of change in claims, and it's also important to account for the holistic impact. An increasing frequency and severity of floods could result in more claims needing to be processed on a regular basis, meaning that you might need more administrators to do it, and the administrative cost associated with this could increase over time. So we need to think about climate risk as being a holistic thing as opposed to just isolated incidents. Applying this thinking to transition risk, we can retrofit that framework in order to assess what transition risk might look like. But in this case, instead of looking at a hazard, we would look at a transition risk driver. That's something like a carbon tax. Exposure in this context is, are our counterparties potentially in a high-emitting sector, or are they high emitters themselves? So would they or could they potentially be exposed to a carbon tax in future? And lastly, vulnerability is any actions they might take to reduce the impact of this driver. So transition plans usually come into play here, which are specifically plans put in place by our counterparties to reduce their emissions, thereby reducing their carbon tax payable over time. So we can use these sub-risk types for transition risk as a list of potential transition risk drivers that could impact a counterparty. Again, as with physical risk, it's important to do some form of qualitative assessment to understand whether all of these drivers or any of these drivers are potentially material for a particular portfolio so that you can focus on the drivers that are most important. Then you can move on to the exposure component of the model. As with physical risk, granularity is a key consideration in the context of transition risk. This graph is an energy supply graph for South Africa under a net zero scenario. This is a scenario where internationally and within South Africa, we reach net zero emissions by around 2050. The top line is the total energy supply for South Africa, and we see a projection of a minor decrease before some recovery leading up to 2055. If we break that down into coal and renewables-based energy, what we see is that coal is due to see a significant decline leading up to 2055, getting to a point where it's almost supplying 0% of our total energy. Renewables, on the other hand, is due to see a significant increase in their total energy supply, resulting in nearly half of total energy being supplied by renewables by 2055. So what this graph shows is that if we apply an energy sector level adjustment to our portfolios, we're going to understate the risk for some portfolios or some subsectors and overstate the risk for others. The other point to take away from this graph is that there is potential for upside risk to transition risk. Some sectors are due to see material improvements in their financial position as a result of the actions we take to fight against climate change. We can't forget vulnerability, the final component of this model. And as I noted, transition plans is really what we would look at in this context. But it is important to appreciate that transition plans are largely subjective in nature. They're usually set by a counterparty and are a counterparty's view of what they can achieve in the future. But we've already seen examples of potential over-optimism in this case. For example, Lego are investigating the use of recycled plastics as a means of reducing their emissions. What they found recently is that the recycled plastic-based approach could actually result in higher emissions than their original Lego brick-making process. So they're now in a position where they've set emissions targets and actually have one fewer avenue to actually realize those targets. So their transition plan is very much at risk and really speaks to, A, the subjectivity from their setting their own transition plans, as well as the subjective nature of us assessing these transition plans and their potential viability. So what we've looked at so far is a direct physical risk impact, a direct transition risk impact, But now it's important to also appreciate that because so many different portfolios within the economy are due to see these direct physical and transition risk impacts, the cumulative effect is expected to have a macroeconomic effect as well. So for example, that flood event in the Durban region could result in reduced incomes in that area, reducing potential demand for, say, cars, having a negative impact on the automotive industry as well. So what this means is that we can use this macroeconomic effect to understand the secondary effects of climate change. But it may not be appropriate for using this for the full effect of climate change. The reason being that macroeconomic variables are at a South African level and an economy level. So they're not granular enough for physical risk assessments and not granular enough for transition risk assessments as well. So focusing solely on the macroeconomic effect could result in a scenario where you're only measuring the secondary effect and not the primary effect of climate change. So now we've got a whole bunch of puzzle pieces. We have that direct physical, direct transition, and now the macroeconomic effect as well. How do you put all of this together? It seems like these things are doing very, very different things. Now, it's useful at the outset to assume that all of these effects are independent, meaning that if you think that physical risk is going to increase your risk by 5%, transition by 10, macroeconomic risk by 20, you can multiply or increase your numbers by 5, 10, 20% respectively. Now, it isn't actually that strong an assumption to assume that physical and transition risk are independent at a point in time. The reason being that today's physical risk is impacted by historical emissions, and future physical risk is impacted by our transition plans today and our emissions today. So at a single point in time, the two are arguably independent, but they might be correlated in a lagged fashion. So in theory, we should be able to measure climate risk, or rather the climate risk impact on our portfolios. It's useful to take a step back and just note how many assumptions we've made in order to get to this point. We've made assumptions about the scenario, about how that scenario translates into some form of climate and transition risk or change, how those climate changes and transition changes impact our portfolios, and potentially any assumptions made in understanding these results. It's also important to note that because this is a scenario analysis exercise, and because of all of those assumptions being made, this is not a predictive exercise, which is often easy to forget when you're presenting point estimates to a range of stakeholders. It is still an incredibly useful exercise. It's good for understanding materiality. It's an indication of how bad things can get. And within a scenario, we can use this for comparisons between sectors, between parts of the country from a risk perspective. And it's also useful for things like reporting. You can use it to inform TCFD reports. You can use it for informing strategic decision making. And once you get more comfortable with measuring physical and transition risk, there's a potential for a portfolio optimization exercise where you optimize the potential return for a given level of climate change.
On to guidance and skills. There has been numerous publications around the topic of climate risk. For example, the BCBS has published numerous papers, the more recent being the Principles for Effective Climate Risk Management. This paper covers various principles such as corporate governance, internal controls, risk assessment, and an important principle being climate scenario and stress testing analysis. Across Africa, various regulators have also started to publish guidance on climate risk management. We've been involved in assisting a few banks across Africa in coming up with plans in order to meet their requirements around climate change assessments and disclosures. A paper which we found particularly exciting earlier on was a paper by the UN on a good practice guide to climate stress tests. This paper highlighted various recommendations and improvements around data, skills, human resources, and the ability to interpret results. Closer to home, the South African Reserve Bank and the South African Prudential Authority has also been quite active on the topic. Earlier this year, the Financial Stability Review highlighted a risk in that the South African financial sector are underprepared for climate change assessments. Further, the Prudential Authority has also released multiple communications on the topic to both banks and insurers, the more recent being out for comment in the last few months. In the more recent communication, they have proposed various additional reporting requirements for banks in their ICAP and for insurers in the OSA. This additional reporting requirements includes climate scenario and stress testing, assumptions, methodologies, challenges faced, any particular changes in business strategy, as well as adaptation and mitigation plans. An important consideration for the SARB will be in their 2024 Common Climate Stress Test. This is proposed for participating banks in South Africa and will be the first of its kind. It'll entail both qualitative and quantitative assessments. Qualitative assessments could be for risk types such as operational risk, and quantitative assessments could be for risk types such as credit and market risk, including climate-sensitive sectors, as well as the bank's largest exposures. We foresee various challenges for institutions in order to conduct such an exercise. The first would be around data. So this would be the requirement to gather and collate climate and weather-related data, to geolocate their banking exposures, both point in time and historically, as well as requirements for insurance coverage or emissions of their portfolios. Secondly, a challenge will be around granularity. So this is the ability to model at some sub-regional level and may require additional improvements around classifications around industry and sectors. And one of the final challenges would be around expertise. This is both expertise in deriving these assessments, as well as interpreting results and creating action plans. On the topic of expertise, various professional bodies have started to introduce courses on the topic. For example, GARP was the first to introduce their Sustainability and Climate Risk Certificate. The IAA has also released multiple publications, including some guidance to actuaries. Further, the I4A and SOA have also recently launched their certificate in climate risk. I have not forgotten about ESSA. I'll chat about ESSA in the next couple of slides. The next question is, what skills are required to deliver on such a climate stress test? We've put together skills which we think are important in order to deliver on the stress test. Finance. This includes the understanding of financial products, the assessment of financial statements, micro and macroeconomic principles. Risk. This is the ability to identify various risk types in an organization, the assessment, quantification, and management of risks. Coding. This could be an improvement to coding skills and could take many forms, such as learning a new coding language, a new software package, or learning new data structures. Fourthly, climate and geospatial. We believe these are new skill sets for financial institutions to learn. At this point, it's worth noting that the intersection of this Venn diagram represents a very rare skill. Now, many institutions won't have the luxury of a CRIS available to do the analysis, and as such, they would require to upskill or have varying skill sets across the departments, or even outsource where practical. The next question is, where could actuaries fit in, and how could the actuarial skill set also assist in such an exercise? I think many of you in the room would agree that actuaries like complex problem solving. They do understand various risk types, can assess and manage risk. They should have an understanding of the basics of insurance and banking. And further, coding and climate risk have been introduced into the actuarial syllabi. On the topic of the actuarial syllabi or the actuarial pathway, the next slide highlights the map to qualification. And it maps out the skills which we think are important that are gained from the path to qualification in order to conduct climate risk stress testing exercises. We do note that multiple skills are gained through the path of qualifying. However, there are some minor deficiencies. This could be around coding, geoanalytics, and climate-related knowledge. Moving on to some of the ESSA initiatives on the topic. This is not an exhaustive list, but firstly, around education. There is a drive to incorporate climate and ESG topics into the various subjects and syllabi. On the banking practice area, they've been the first to introduce the topic of climate risk into their fellowship subjects. And luckily enough, we do know the authors of those sections, and we will be assisting the other subject areas in coming up with their related sections. On the other ESSA committees, they've been involved in areas such as including the topic at various seminars and involved in proposing various guidance notes or information notes on the topic. We've all heard by now the ESSA Climate Change Committee was launched in the last year and has successfully held their first seminar in the last month. Key takeaways or conclusions from this session. Climate risk stress testing is an important tool for institutions to assess the impact of climate change. As we are aware, climate change has and will continue to have a disastrous consequence or disastrous consequences across South Africa, Africa, and globally. A climate risk stress test is an important tool for institutions to assess their strategy and business models and to improve the awareness of the topic at their institutions. The importance of banking and insurance, the importance of the banking and insurance interplay in the South African financial sector around climate risk is an important one. The climate risk topic and climate risk stress testing is complex, is new, it's complex, requiring new sets, new ways of thinking and skills around it. We believe actuaries can play a role in the topic in various ways. And at this point, it's worth noting that institutions should be, by now, looking at climate change assessments, especially with regards to some of the new regulatory requirements that are coming out, and especially with banks, some around the potential sub-requirements for next year. And finally, the overall topic of climate risk stress testing is quite a large one to condense in a single session, and we hope to have further sessions on the topic, and we hope to see you there. Thank you.
I think a very sober discussion and presentation by Chris and Jerome. We open it to the floor. Of course, you can also add your questions to the online app, but we already have one take at the back, sir.
Cool. Thank you for the presentation. I'd like to play a bit of devil's advocate, right? So my question to you is that, do you foresee potential increased conflict between financial services providers and be it the regulators and government per se? So I'm playing out a scenario whereby you mentioned that in some areas there's already a reluctance or withdrawal of, say, insurance cover, and one can foresee how that would then interplay into be it lenders not being willing to lend or provide certain financial products in certain areas, right? And at some point, all right, that may lead into decreased economic productivity in different regions and affect, the person on the ground. So I'm thinking of it maybe from a politician's point of view, because climate risk is largely somewhat what ifs. Am I willing to lose an election by making people unhappy because of a what if? So do you foresee a potential for increased conflict between the regulators and financial services providers?
Maybe I'll start. Okay, so I think in South Africa there's an element of a social good that is required. It'll be difficult for example, lenders to say they're pulling out of certain regions. especially given the population dynamics and the income dynamics as well. So there's an element of social good which needs to continue. And for insurers, if they would pull out of certain areas, that will be obviously a critical component. However, we believe there might be some government intervention then in the form of a fund or additional insurance like a SASRIA to cover certain events as such. But I think it'll be an issue for South Africa to actually start removing the requirements or removing lending or even insurance coverage in certain regions. Chris?
Yeah, so to be honest, I was hoping to get a political question maybe at the end after easing myself in with some technical questions. I think it is difficult. So I think we're at the point where we still are trying to understand the materiality of the risk, which is a key step. And it could get to the point where we do have enough appetite to continue. So once we have that information, obviously then it's a subsequent conversation. And I personally don't have the answer. Let me be upfront about that. But the implications of different solutions are that if insurers continue to, this might be an insurer calling now, so if insurers continue to offer insurance, essentially what's happening is that individuals in low-risk areas are subsidizing individuals in high-risk areas, short of increasing premiums to the point where they're unaffordable. But even the alternative where government backs a scheme to continue offering insurance, that means the taxpayer is ultimately paying for those. So ultimately, it's a situation of we either all kind of come together and pay for it, or the insurance isn't offered. And that's, as I can see it, the alternatives that we're facing. I just don't know which one to go for.
Hi, Jerome, Chris. The models that you have proposed suggest that in future, a home loan would not be offered to someone, say, that was at high risk of a flood risk, for example. And as someone who has a 50-year flood line on my property, that makes the resale value of my house zero. If I cannot get, somebody else could not get home financing for the house should they buy it from me. So what do you see in this sort of scenario, especially since you may be my existing home loan financier?
So decision making, especially for a bank, off the back of this information is more complex than simply saying high or low risk. And as you say, there is an alternative or a secondary implication. So there's contagion risk associated with these decisions. If, for example, you pull out of certain areas, the house price for other potential bank exposures could also tank. So it's a more of a, well, potentially more of a portfolio level assessment. And again, that's very much once we even understand the materiality in the first place. And it could be the case where once we've calibrated these models sufficiently, that we actually, again, still have enough appetite. Yeah, so it's a complex thing, and it's probably not the answer that you want, but even once you have the model in place, the hard work hasn't finished. There's still a lot of hard work to be done off the back of that in terms of understanding the ramifications of your actions off the back of that information.
Maybe I can add as well, potentially sometime in the future, there could be a valuator coming to your house and suggesting some vulnerability or adaptation measures for floods. That could be something that could play out in future.
To be honest, yeah, that's a really, really good point. Probably should have started with that. But ultimately, there are more solutions than simply do or do not. For example, I think Greyton is a small town in the Western Cape, essentially in the middle of a floodplain, and they've just built the houses to be more resistant to flooding. And as a result, things are probably going to be okay. So there may be a cost involved, but ultimately it's not all doom and gloom.
Do you have any other questions from the floor? If not, we'll go to online.
We just have one question from Tapelo Sekanka. He says, great presentation. How is the availability of sufficient and accurate data? I suppose it is, what is the availability of sufficient and accurate data on this topic? And what other perils or risk factors do you foresee being assessed?
So data is a big issue. And if you attended the climate data session this morning, you might have got some appreciation for it. The fact that they only included rainfall was a function of the fact that a wide range of climate variables might not be available, certainly not for the period that you might want. So there is often a kind of cost-benefit analysis that comes off the back of it. There are alternatives available to, it was the CHIRPS data set that was used, which is supposedly quite a high-quality data set. And any data set that you use is likely to come with its own assumptions. So even if you are using South African Weather Services data, there are only so many weather services in the country, meaning that in order to get an indication of what the weather was like in between weather stations, you likely will need to make an assumption to do so. So climate data implicitly comes with assumptions. And even on an emissions or from an emissions perspective, you either have firms estimating their own emissions, which is likely done by an expert, but maybe an estimate, or you're forced to get a calculation of emissions, which again is a modeled output. So before we even get to the modeling, chances are you're using modeled output already. So there are open source data sets available. Paid for sources probably are going to be quite expensive. So then it's just about appreciating the potential impact of that and ensuring that you've sufficiently validated the data. So there are ways to validate climate data sets to ensure that what you're seeing in the data is reasonable. The other issue is internal data. So because geographic granularity, for example, is an important consideration now, but may not have been 10 years ago, whether your data or your historical data has this information in it and it's accurate also remains to be seen. There's potential error for that. Geocoding isn't a perfect science. What you might find is that you can geocode 70%, if you're lucky, of your portfolio to a street level. Everything else is maybe to a suburb or sort of higher level as well. So everywhere you look, there is additional error, which again is why this is not a predictive exercise. This is indicative of how bad things can get. But again, the appreciation for the potential assumptions being made needs to come through in the final output.
Any other questions? Maybe just one for me. I guess the point on the modeling, the lack of data, the number of assumptions in there, all that's going on, I see a lot of discussions about where will insurers not insure. I guess it depends how far your doomsday scenario gets to, but I suppose all of this needs to be done in the context of, what can be done from a broader perspective, because ultimately this is the new world we are getting to. Just from your guys' view and research, do you think that there is enough, or would you like to see more being done by regulators, actuarial societies across the world? Just your thoughts on that?
Cool. So I think from my side, what this presentation illustrates is that there is a lot of work that goes into building a climate risk model. So I think more research around something of a benchmark model would be a good place to start. As far as I've been able to see so far, there isn't any one model that is good for physical and transition risk, certainly not from a banking perspective and certainly not from a general insurance perspective. So that would be a really useful starting point. So at least we all have a common model to work from, so that, because the other issue is that if everyone's building their own models, one model could say one thing, another model could say another, and then you act differently as a result. There is already a lot of work being done. Obviously, the fact that there are talks on this, there is a climate change committee. We are working hard to understand the nature of the risks, and I realize I didn't answer part of the one question with what other perils we might look into. Those types of discussions are being had at different committees. But the improvement of data is an area that could potentially, we could benefit from. Potentially, even having something as a kind of industry fund where we source data directly from the South African Weather Services and make it freely available for financial institutions to use. Something like that would be helpful to A, ensure that we're all using the same data set, and B, to ensure that the data set is of sufficient quality. So there are areas for improvement, but it's also one of those things that we need to kind of go through a little bit of teething first to understand how big the problem could be before we can actually allocate resources to it.
Awesome. Thank you. And again, guys, great presentation. So just wanted to check, do you foresee any potential discrimination from the models where people in certain geographical locations might be declined certain products or priced out of the market and they are not able to participate in the economy as recommended by the model? And if so, are our credit bureaus or regulators able to kind of intervene and let you guys do business with those guys, even though your model might predict that this person is at high risk of a certain peril from climate risk? Thank you.
So maybe I'll start. So I think, as we mentioned, I don't think the models as yet would be, I guess, telling strategy on how to maybe decline certain areas or certain products. It could be used for, long-term assessments or to change future strategy. As for now, to impact pricing or decision-making, I think it's a bit of a while to get there. And as we said, there's an element of social good and interaction that is required. It'll be difficult for example, one insurance and banking group, for the insurer to pull out, but the same bank under that group wants to lend. So yeah, I think there's a bit of work to do there.
So there's definitely an ethical discussion around this, a social good, to be honest. I think this is potentially why actuaries are in a good position to manage climate risk, because we do consider the ethics as part of our professionalism. But yeah, I think we obviously don't want to jump the gun. I think we're still in a position where we're trying to assess whether it's something we even need to act on in the first place. And then once we are a bit further along the journey, then it's probably an industry-based collaboration to start having conversations around, if we do pull out, what is the implication for all of our portfolios? And it could be that financial institutions are actually willing to still cover that cost, because the implication of not offering those loans in the first place could have a much deeper impact on the country and on themselves.
We have a question online, excuse me, from Wilhelm von La Chevalerie. Asks, if climate risk is real and yet we have witnessed a 1 in 100 or 1 in 20, according to reinsurers event in KZN, we can expect an increase in claims cost arising from the secondary perils. Do you think short-term insurers will apply models with these perils on the policy inception or sale stage? The government and local municipalities also carry a responsibility to ensure that houses are not built in areas below 50 or 20-year flood lines. I'll also add a question to that, is what impact would in-migration, particularly from areas affected by climate risk, and not just by floods, but also by droughts in many parts of the country. Gauteng and the Western Cape bears the brunt by either failing municipalities or by incidents of climate change in this regard.
So I probably should have spoken about this a bit more in the presentation. Infrastructure maintenance is also a key consideration in the context of municipal requirements. So if drainage systems start to break down, floods get worse. So infrastructure is an indication of vulnerability, both for general insurers and for banks. So that very much is a key concept. I'm probably going to cop out and say we're going to make a few actuarial assumptions here. But the current kind of status quo from a modeling perspective is to make a static balance sheet assumption, where you assume your balance sheet doesn't change for the forecasting period. The reason being that trying to forecast your balance sheet for a 30-year period is incredibly difficult. So off the back of that, you would kind of assume that people aren't moving around yet. So that would be a really good enhancement. But I think we're still trying to figure out even if people don't move, how bad could things get kind of stage. And again, sort of the policy inception stage type of, or informing those types of things, still need to assess the materiality first. And then chances are that may be a route, but it's still too soon to tell.
Do we have any other questions, contributions, comments from the floor?
Then we'll end it there. Jerome, Chris, thank you so much for a intriguing discussion.